You're watching this because every stock you seem to buy only goes down. You probably have lost money in the stock market for years, and you've watched everyone else's portfolio but yours go up in value. Well, you're in the right place. I manage millions of dollars for dozens of clients, and I'm going to show you in this video today why your portfolio is not doing well. I've been interviewed live at the New York Stock Exchange by Charles Schwab, so I know my way around the financial statements, which is where we're going to start. So we're going to use Ulta Beauty as an example, and we're going to start with the income statement. And this is the fundamental place to start making better investment decisions. You watch this and you are going to make more informed, more wise choices. So here we go. The first thing you're going to notice is revenue. Revenue is just the money you make selling your goods and services. And in fact, it's really a proxy or a substitute for demand. So when we see revenue going up, what that means is demand for your products and services are going up, and the reverse is true. Revenue going down means that less and less people want to buy your stuff. We don't want to own companies like that. Most people don't know that revenue is a proxy for demand. And so when you look at it through that lens, you can understand making a better investment decision starts with buying companies who are in demand more and more every year. The line item that you're going to see right underneath is cost of goods sold. That is just the cost of producing the goods and services that you're selling. And so when we take the difference, your revenue less your cost of goods sold, you're going to get your gross profit. And gross profit or gross profit margin divided by your revenue is a crucial financial metric. You probably see it quoted in the media all day. Gross margins are very important to the health of a company, and we want fat gross margins. We want our gross margins to be taking GLP-1s. If I continue down, we've got selling, general, and administrative expenses. That's like salaries, marketing expenses, the cost of having a warehouse, all different kinds of operational expenses are included in that line item. So they're not tied to the product or service being sold. These are costs that are operational to keep the company in motion. So when we take our revenue and subtract our cost of goods sold and our selling, general, and administrative expenses, we get operating profit. That shows us how much profit the company's making after paying for its expenses. It's a very important line item that a lot of people overlook. The line item underneath you'll see is interest expense. Companies borrow money just like people borrow money, and they have to pay it back just like people have to pay it back. And when they do, they have to pay interest along the way. So you'll see that interest expense, that cost, located on the income statement. Now, how do I know all this? Well, I run an investment firm. I manage millions of dollars for 52 clients. I oversee all of their portfolios from brokerage accounts to rollover IRAs to 401ks to 403bs to 457s, all the way down to Roth IRAs. So when you do something every day, it becomes second nature. If we keep moving down, you'll notice that we've got net income. That's the ultimate profit that the company is putting in their pockets, and it's what earnings per share is ultimately derived from. You'll see that in the news a lot. Earnings per share, EPS, a company's making more money or less money than the year before or the quarter before. Earnings per share is your net income divided by how many shares you have outstanding in your company, and it just explains, it gives you a ratio of how profitable your company is. And so naturally, we want our earnings per share to be really high and not really low. But again, most people don't look this deep into the financials, and that's a big reason on why their portfolio is not doing well. Now we're going to go to the balance sheet. The balance sheet is set up in three sections. You've got your assets, your liabilities, and your equity. The difference between what you have, your assets, minus what you owe, your liabilities, is your equity or ownership stake. It makes sense, right? If I have something, but I owe something and I net the difference, well, that's what I really own. So the balance sheet is broken up into those three sections, and the most important line item in the assets is going to be your cash. We want to own companies that have a lot of cash on the balance sheet. The most important item in the liability section is long-term debt. Because remember, companies are like people. If you have a company that has a lot of debt, so they owe a lot of money, but they've got no cash, well then that's a major problem, right? We would say that company is insolvent, the same way you would say a person who had a balance sheet like that is bankrupt. Somebody who has a huge mortgage, a lot of auto debt, a lot of student loans, credit card debt, but has no cash in the bank account is bankrupt. It's no different for a company. So when we're looking at the balance sheet, we want to look at the cash, we want to look at the long-term debt. The other line items are very important as well, but they're more important compared year over year than just inherently on their own. Because someone who's analyzing a stock, you want to look for an anomaly, right? Something that happened in one year that maybe wasn't there in the other years. But what's constant across all years and all companies is looking for businesses that have a lot of cash and not a lot of long-term debt. And that ultimately means that the business is solvent and there's likely a lot of equity or value in that business. The last financial statement that we're going to cover is the cash flow statement. This tracks the flow of cash all the way throughout the business for an entire year. We've got three sections. We've got cash flow from operations, cash flow from investing activities, and cash flow from financing activities. The difference between all of these three sections is ultimately the cash that has been produced and left over at the company at the end of the year. And what we want is to own companies that are lining their pockets with cash. We want companies that are printing cash, because ultimately every business is worth the summation of their future discounted cash flows. That's a fancy way of saying what a business is worth is the cash it produces in its lifetime. Now, when we look at the cash flow statement, the most important line item is the cash flow from operations. We want that line item to be positive, because that means that the operations, what the company is doing, what they're selling, is producing a lot of cash. That means they're operationally very solid, great foundation, and they're efficient. That's the starting block. Well, we've got cash flow from investing. So companies have to invest back into the business to continue growing it. So we're going to look at the capital expenditures line. That line item outlines what the company is taking in to reinvest into the business. And ultimately, we're then going to check the cash flow from financing activity to make sure that the company is not issuing too much stock or borrowing too much money. And if we look at all of these three financial statements in conjunction, the income statement, the balance sheet, the statement of cash flows, we are going to come up with a very fundamentally sound analysis of every company that we look at. And then we can look at the company's stock price to see if it's worth buying, to see if that stock is selling for less than what the company is worth. This is the strategy that Warren Buffett, Charlie Munger, Peter Lynch, all the great investors use, and it's the same strategy I use with all my clients at DocShah Financial. If you're sick of losing money in the market and paying more in tax, just shoot me an email, raul@DocShahFinancial.com. I'd love to hear from you and your personal situation and how I can help you get back on track. Thanks so much for watching the video. Like, comment, and subscribe, and I'll see you in the next one.